subscribe now and press the bell icon. Never miss an update.
So now we finished chapter 3rd, and that was all about different kind of incomes and all. And now we're gonna again we're gonna focus on the expenses, the adjustments for expenses. Okay, that needs to be, those adjustments need to be made in order to come to the correct AGI. So these are called above the line deductions. Okay, so above the line deductions are deducted from gross income to arrive at AGI. So first of all, we'll add all kind of income, whatever the taxpayer may have, and then we're going to make some adjustment. There's some reliefs that can be given by IRS that, okay, if you're having certain kind of expense, we'll let you take a deduction for that. Or if you're putting money into certain plan, we'll let you take deduction for it. So you can reduce your income by that much amount, whatever is allowed by IRS. So those adjustments we're going to talk about. And these are all called above the line deductions. Why? Because they are done above AGI line. If you look into Form 1040, there are certain deductions. There is a line item for adjustments or deductions just above AGI. Once that is done, then gross income gets adjusted by that, and then we derive to AGI. Okay, the first one, what they're talking about is educator expenses. These are usually for teachers and all, and it's not a very general category, not like everybody is going to get it. This is especially a relief which is given to primary and secondary school educators. And what this says, again, I mean, teaching is a very noble profession, and also like there has to be some benefits. So there are certain merits, social merits decision that IRS takes and all, and they're saying that if you are a teacher, we're going to give you certain more benefits. So what this says, you can take a deduction of $250 straight away. Each taxpayer may deduct up to $250. Those are very simple. Again, this is not for college professors and all. This is only for primary and secondary school educators. So if they may be having some unreimbursed expenses paid or incurred for books or supplies and all, so they're saying they just go ahead and just deduct $250. And again, what is an educator? Just by going and taking couple classes or putting in 2, 3, 4 hours, you don't become an educator, right? It's not like you go and say, oh yeah, once in a quarter I go there and I take a 2-hour class. That doesn't make you educator. So again, there is some specifics to it that you need to be a full-time person, or you need to spend at least 900 hours during a school year educating the kids. And you can be a teacher, instructor, even counselor, not necessarily like a typical teacher. It can be a counselor, principal, or any other help giver. Again, what is meant by school? Again, school is very legal thing. What just somebody calls their daycare as school doesn't mean that is a school. It has to be properly registered and all, and whatever the specifics are given under the law, that's what the school would be. Okay, so Sakshi, can you read 4.1?
Tommy and Lily Jones, a married couple, are both teachers in their local school system. They each spend more than $250 in unreimbursed expenses for books and supplies used in the classroom. They are allowed an above-the-line deduction of $500 on their tax return. The deduction is taken on line 10 of Schedule 1, Form 1040.
Right, so they said that, see, technically it's what IRS says that you should have an unreimbursed expenses. Maybe it's not necessarily school will supply everything. And sometimes they may go and they want to buy notebooks, or they want to make their own, get other reference books and all, which school may not have. Or they may not even be interested in reimbursing for that. Or any supplies that they want to use in the classroom. So they said like $250 a year is enough. Most of things are going to be reimbursed by, most of the things will be reimbursed by school, but up to $250, if it's not reimbursed, you can take. a deduction. So technically, if there is an audit, yes, they need to be able to produce some expenses up to 250 at least, which are unreimbursed, which they can prove that they have spent towards certain school related stuff and it has not been reimbursed. But they don't need, IRS doesn't need you to upload all the receipts and stuff. So and plus it's a very small amount. So they just say that if you're an educator, if you're a teacher, that's why they ask for profession also. When you're filling up form 1040, in the bottom they'll say write the profession of the person. So you can put like software engineer or advisor or consultant or even homemaker. If one of the spouse is not working and they're taking care of the home, then you can always put that as homemaker as well. It's not a mandatory field. I don't think it will give you an error if you don't fill up that field and still try to file the return, but we should definitely go and put all those things, because it's simple. Any questions here? You should be knowing what are above the line deductions and below the line deductions. Can anyone explain? All right, so now the second topic here is health savings account. This is called HSA. Again, this is very important because HSA is very common. It's quite common. You will see the HSA statement when we are working on the tax returns. Shweta, what is it called? What is the form, which is usually given by taxpayers?
98.
Sorry?
5498.
5498 is fine.
SA.
That just gives there's another one.
1099 SA, I think. I'm just getting confused.
Tania, do you remember?
1099 SA. 5498 is correct, but that shows only the contribution, I believe.
Right. So the contribution doesn't impact any tax returns. It just gives some information that, okay, there is the HSA account and all. If the client provides it to us, we should definitely take a look into it and we can save it and we can make it a note that there is some HSA thing. But when does it become taxable? When the money is withdrawn from that account. And as the name suggests, what is HSA for? It's some kind of it's a saving account where you can put in money through your payroll. So basically, employer will make a deduction from the paycheck. They'll put money into HSA account, or employer themselves may also contribute to employee HSA, and that money gets collected over there, or it gets deposited in that account, only to be meant to be used for medical expenses or something related to health. So that's a kind of forced saving. So what IRS is saying is, do not burn away all your money. Save something for your health, because again, healthcare is very, very expensive in US. So obviously for the lower group and all, there are all the medical facilities provided, but still, people. There was some study done. There was some research. I can't remember specifically, but what they said is majority of the bankruptcies filed in US from individuals, and are because they fell sick or they got into some critical illness and they have no money to pay. So all the money went into the medical treatment. So healthcare is extremely expensive. Again, that's another thing that why they're saying that have this HSA account and all. And IRS is giving all the tax breaks that if you put money up to certain level every year in this account, you don't have to pay tax on that. It's pre-tax money. And even if you take it out, if you are using that money for the right purpose, which is going to be medical expense only, then again, you don't have to pay any taxes on it. It also grows tax-free. So again, the form that I was talking about is 1099 SA. You can write it down. That's again an important form. The moment you see the form, it will tell you how much money has been distributed, meaning how much money has been withdrawn from that account. Say like the client withdrew $5,000. Maybe they had some illness and they had to pay, their share of the medical expenses to the hospital. Most of the time, insurance will cover it, but it's not like insurance is going to cover 100%. There will be some out of pocket, or there will be some other expenses which insurance will not cover. So let's say they took out $5,000. That $5,000 will be mentioned on 1099 SA. Now, if we are doing the tax return, we don't pay attention to it. What we'll do, majority of the time we see 1099 SA, $5,000. Okay, go to that form in the software, put that $5,000, box 1, whatever. We need to understand what is happening there. The moment you put that $5,000, it will come up as a taxable amount. You go and check on 1040, face of 1040. What is it doing? Is it increasing your tax? Then if yes, of course, we need to always go and check what is happening. Don't just like go, okay, I don't know, the liability was $1,000 earlier, suddenly it became $1,200. I don't know what I did. Something happened there. That should not be the case. We know exactly what we are doing. If we are putting HSA from 1,000, it becomes $1,200. We should immediately know that, okay, this amount of distribution is coming up as taxable for the taxpayer. And we know the rules that if this amount is withdrawn for medical expenses, then it should not be taxable. But software doesn't know. Software doesn't know whether you're withdrawing that amount to go on a vacation and pay, for some air flight and accommodation and all, or you want to go for luxury items. Like go and do some shopping, or you are actually using that money for medical expenses. So it's our duty. We need to ask the client, hey, we saw that you have, you have HSA expenses, HSA distribution. We saw a 1099 form. What did you do with it? Why did you withdraw money from that account? Where was that all spent? Do you have the proof that if you're withdrawing $5,000, you're actually spending it for the right purpose? Can you give us some statement or something? We don't really need to audit them, but we need to tell them that we hope you have some proof and all that it has been, if the client says, oh yeah, I paid everything for medical expense, we need to tell them, okay, fine, then, please make sure you're retaining all that proof and everything, the hospital bills or whatever you got. And then in that form, 1099 SA, there is like somewhere in the bottom also, you will see an option that what was the amount incurred for qualified medical expenses. So in that box, if you go and if you tell the software that yes, 5,000 was withdrawn and 5,000 was used towards paying medical bills, then the moment you put that thing, it becomes non-taxable. Go back on 1040 again and check what is it doing to your taxable income, to your tax liability, to your ultimate refund or end tax liability. Then we will understand the logic, what is happening. Okay. So again, that's a common form. We should know the moment we see 1099 SA, we should know, and we should know what question to ask the client. So now there are certain limits. It's not like, people can go ahead and put in like $15,000, $20,000 in HSA saying that, oh yeah, I want to put $20,000 this year, or I want to put $50,000, or I want to put 10,000, whatever. There's a limit. IRS will say, you can put as much as you want, fine, but we will give you a tax break only on so much amount. So if it's only self-coverage, you can contribute up to $3,500. If it's family coverage, they allow you certain higher amount. But this might have been changed. So we need to see. Again, the software will give you, when you go to HSA form, it will tell you maybe the limit has become 4,000. Or maybe this has become 7,500 or something. We need to check. It doesn't matter what the limit is. Okay, that should not be our concern. What is it and all? And we're not going to mug up all those things. We just need to understand the basics behind it. So if the taxpayer are obviously, if they are aged more than 55 and all, their medical needs may be high. So for them, the contribution limit or the allowed contribution is higher. And again, contributions are not allowed for taxpayer which are 65 plus. And if they're enrolled in Medicare. Medicare is the free medical facility provided to US citizens from the government. So what they're saying is, if you're above 65, you anyways get free medical facility and all. Why do you need to put money into HSA? So it's not allowed. Okay, there is a requirement. The Obama healthcare bill, which was passed, they made a requirement that health insurance is going to be mandatory for everyone. If you don't carry a health insurance, the government will penalize you. That's why there is a question that is being asked in 1040 form. Does the taxpayer have full year of coverage or health insurance coverage? And it's quite possible that they may not have. That's why what they have done is they've made these marketplaces for health insurance. Marketplaces meaning some government-led, offices or like institutes where you can go and buy health insurance. So that will be available at a very, very cheaper price. And that is available for people, those who don't have jobs, those who don't have income to go and buy their own self health insurance and all, or maybe their employer is not providing the facility, or maybe they're unemployed, whatever reasons they may not have it. So they can go and they can enroll themselves in that marketplace for health insurance and buy themselves health insurance. Again, those are different forms. So even if the client, if they are going to health marketplace and buying insurance from there, that also we need to disclose properly. Because there's something called premium tax credit. So what government says that, okay, we will pay on your behalf and all, or you pay so much, we'll give you tax credit back. So if you're paying for health insurance, you'll get some kind of advantage. Because they're forcing people to enroll there. So they're also giving some benefits back. Now that's a different topic. I think we're going to cover it separately, but this is all going to be covered in health insurance. But we need to pay attention to all those little check boxes are there. Do not ignore them. If it's asking a question, was the taxpayer enrolled for full year in the health insurance, or did they have coverage? You need to mark yes or no. If you don't know, let's ask the client, did you have health insurance for full year? And this is meant only for those people who are staying in US. It's not meant for people outside US. So if a client is staying in India, and you can just mark it as yes, or even if you don't mark it, it's fine. Because there's no such rule that even in India they have to buy it and all. I mean, US government is not imposing that rule. So that's why again we have to mark that box properly, the taxpayer staying abroad. If we tell IRS that we are staying abroad, so many of those things, like, they know that, okay, let's not penalize them for this thing, that thing and all, because they are not even in the country. So if we have a client, we know they're staying in India for full year, or they're Indian ordinary tax residents, let's make sure we are that box, and it should come on top of 1040 that this taxpayer is staying abroad. Also try to put their India address. A lot of times we always put US address, saying that mailing purpose, it will be easy and all. That's fine. You can do that. It's not a problem. But again, if we put India address, that gets, more, I mean, the IRS gets a better confirmation that their address is also foreign address. So this person is not here. So we're giving all correct information to IRS. I mean, like, otherwise, if you put, say, California address, California government doesn't know where you are staying. They just see California address, they'll send a notice. Well, you have a California address on 1040. You are reporting $1 million in your income. Why California taxes have not been filed? Why are you not reporting that as California income? They don't know where we are staying. Like, unless we mark properly taxpayer staying abroad, or we put some other address and all, then they'll come to know that, okay, this person has nothing to do with California. They're probably just using the address only for convenience purpose. Okay, so this is all done. Any questions here? Oh yeah, one more. Yeah, sorry, go ahead. Somebody unmuted themselves. Do you have any?
I just said no questions.
No, okay. So one more point is that if the client asks us, oh, 31st December is coming, I need to put money into HSA. What is the deadline for that? Do I have to make sure the money goes in before 31st December? So there are certain plans where we can still fund those accounts until April 15th, 2020. I'm sorry, until April 15th of next year. So for the year 2022, if the person has not put in money, they can still do it until April 15th. Same thing with IRAs, individual retirement account. If they did not put in money before the year end, IRS gives them extra like 3.5 months. That okay, April 15th is the due date. If you want to go back and if you want to make sure your contribution is going for the previous year, you still have time. And in certain cases, when we file extension from April, the deadline goes to October. So in certain places, even that deadline gets extended, like 401k contribution. IRA will not get extended, but certain other deadlines get extended. So if the client asks us how much time do I have, until when should I do it, we need to tell that make sure you're doing it by April 15th. Okay.
Ma'am,
Yes.
ma'am, what if we have not contributed the specified amount in the year?
So that's what I'm saying. They have time until next year. 3.5 months they get extra to put that amount for the previous year. And if they don't want to contribute at all, that's also fine. They just don't get any tax break. So do you understand it now, Divyansh?
Yes, ma'am.
Okay. What is the form that needs to be used for
Ma'am,
HSA distribution?
ma'am, we are using the form 1099 SA for the amount withdrawal from the account and the form 5498 for the gross contribution.
Very nice. Self-employment deductions. Okay, we'll quickly go over that as well. So self-employment, again, like how many of you know that there's something called payroll tax? Okay, let me just give a very quick background about that. See, in US, there's something called Social Security tax and Medicare tax. So those are not income taxes. Those are mandatory taxes, and they are called payroll tax or self-employment tax. If the person doesn't have payroll, if the person is not on payroll, does not mean that they are not paying these tax. These are mandatory for everyone. Again, you can call that as part of US culture or whatever. People don't save enough. They live on credit cards. They're like, they just blow up whatever they earn and all. So again, that's a forced way to make sure that people are putting money into social security and Medicare funds by way of these mandatory taxes. So what is social security? As the name says, it's a security when after your retirement or even before retirement, if the person falls sick or like gets handicapped or temporary, have some physical disability or permanent disability, something happens, or the you know the the main person who is earning in the family, the bread earner, if that person dies, who is going to support the rest of the people? So that's where social security comes into the picture, and government gives certain amounts every month. Those social security taxes, there's a separate department called Social Security Administration Department. It does not go to IRS. IRS will not take away those taxes and then keep them in their treasury. It goes to Social Security Administration Department. And there they keep an account for everybody that throughout your life, this is how much you have contributed to Social Security. Because every month when a person is getting paycheck, then certain amount will go towards Social Security and Medicare. What is Medicare? Medicare, we just saw it. Medicare is again the medical facility given by government for all the people, those who are above 65 or those who cannot afford and all. Again, those are all free facility. So, but somebody needs to fund them. That's how they're doing it, by way of these compulsory taxes. Now that is a big number. It comes to almost 7.5%. So if somebody says, well, US has very low taxes, all you guys are paying us only 22, 23%, and in India we are paying like 32%, 35%, we should also add up, said, hey, that's not enough. Huh? In US, people also have to pay 7.5% extra. You don't call that as income tax, but there is a tax. It's right away, it's been put up on your income only. It's directly related to your income. There's something called net investment taxes, which is again 4% extra, and also a lot of, we need to know all these things. Those are also taxes. So if somebody tells you that, can you do an analysis where I'm paying more in India or US, don't forget about these Social Security and Medicare taxes. So what happens, and now what a government says, what IRS says that this, or what the US government says, that this burden of Social Security and Medicare should be borne by both employee and employer. So the total taxes will come to 15%, 7.5% of that burden will be taken care by employee, 7.5% will be taken care by employer. Again, this is a very common question that companies may come and ask us, hey, I want to hire someone on payroll, and maybe say that I want to pay like $5,000 a month. What are going to be my overheads? That's very important to know. It's not just 5,000 that the employer is paying out of pocket. There might be a lot of that goes on top of that. Maybe they need to keep a budget of 6,000 or 6,500. So we need to be able to tell them that, okay, this 5,000 is just the gross pay. On top of that 7.5% extra you need to pay. Maybe then whatever state you are in, that state may also have something for employer to bear the burden, maybe 1-2%. On top of that, there might be health insurance and all. Again, that's not mandatory. Employer can say, well, if they don't want to pay, they can say they don't want to pay. But because it's a culture there that everybody needs to carry health insurance, usually companies will pay that. So that all cost needs to be added. 7.5% is very important cost. So that's, and then why I'm talking about payroll taxes here, because exact same thing is being replicated when the person is self-employed. Otherwise, what everybody will say, they'll go to the employer and say, hey, don't take me as an employee, okay? Just pay me as a contractor. Why? Because you guys will not take away 15% extra, or maybe 7.5% extra. It's a saving for you, it's a saving for employee. Don't take me as an employee. Yeah, so they know all about those. So what government says that, okay, fine, you don't want to be an employee, don't be an employee. Take that payment as a contractor or as a self-employed person, but on your self-employed earnings, you will pay something called self-employment tax, and that self-employment tax is nothing but, in a way, payroll tax. Okay, but now the entire 15% burden has come up on the consultant, on the contractor, because when you're a contractor, the employer doesn't care about anything else. They said, okay, $5,000 a month I need to pay. Here is your $5,000 per month. You take care of your taxes and everything and all. We are not going to take care of anything. In fact, they don't even need to do withholdings. In India, there has to be a mandatory TDS, withholding and all those things. The employer doesn't even need to do that. They said that it's your hassle. You manage your taxes. You pay your quarterly estimated taxes or whatever. We don't care about that. So the person now does not, if he's a contractor, they don't get to share the payroll tax burden with the employer or the company who has hired him. So the entire 15% burden now comes on the contractor. That's not fair, right? That's very unfair. So now the contractor will go and they'll complain IRS, what is this? Or complain to the US government, what is this? Like, I'm a contractor, I'm like working so hard and I don't even get benefits, what an employee gets, all those things. On top of that, you want me to pay 15%. So in order to make it fair, IRS says, fine, anyways, 15% has to be paid. Sorry, we cannot do anything on that. But we'll give you a relief on 7.5%. So you take that as a deduction. You reduce your taxable income by that much amount. And that is what we are calling about the above the line deduction. There is a line item called self-employment taxes deduction. Go and check on Form 1040. So that's where, and again, this will come automatically. You don't have to go and keep, okay, this person is having self-employment income of $50,000. Let me calculate what is 15%. Let me go and take 7.5% and put in that line item. No, nothing. That is all being done by software. Because there's already an algorithm there. There is already, like, the program has been written up. The rates are standard. It will all be taken care, but we need to know why that amount is coming, why it is being adjusted, why the income is getting reduced. What is that extra tax? The client may come and say, what is this other tax? Income tax, I understand. There's something called other taxes. What is this? Why am I paying other taxes? I don't even have so high income. I make only like $30,000 a year. Why are you asking me to pay that? Then we need to tell this is the self-employment taxes. We cannot, this is mandatory. Nothing can be. In fact, that self-employment taxes does not even get reduced by foreign tax credit. So if the person is in India and working as a contractor, and we are putting that income in Schedule C, the self-employment taxes will get triggered. They're paying much more in US. Maybe they're paying $1,000 extra in self-employment taxes. And if this person says, I'm already paying 35% in India, let me get tax credit. They cannot, because as per DTA, the tax credits are given only for income taxes. Or the other way around, the Indian government will not give tax credit for self-employment taxes because that is not a income tax. And when we are putting that in 1116 form, which is for foreign tax credit, it will not reduce self-employment tax liability in 1040. Okay. There's one good thing that what IRS says is that your social security tax is capped at certain level. So this was the amount 132,000. If the salary is below that or the employment earnings are below, you pay 6.2%. If it's higher that, then you pay 6.2% of this amount. It's capped at certain level. Now again, this might have changed every year as it keeps changing. So which is good. It's not like, a lot of people we see their W-2 income might be like $500,000, 750,000 or 1 million and all. So it's not like they'll pay straight away 6.2% of 1 million. It gets capped. So that's a good thing. Second, not so good thing is that there is additional Medicare tax of almost 0.9%. If the income is above certain level, then what IRS says is like, others are paying 1.45% or 1.45% of Medicare. You guys pay like 1.45 plus 0.9. And there is a form for that. All those forms will come automatically in the software. But you will see that if you see in the taxes, you will see other taxes, then you should see, oh, what is that other tax coming for? It will tell you there's an additional Medicare tax. Because the income has crossed certain limit, so there is a extra tax on rich people that they want to put. Okay, so I think we'll just stop here. Self-employment is again important. We need to understand this is very, very common thing. Next, we'll start with some retirement plans and all. We'll do all this tomorrow. Self-employment, let's just do this. Self-employment health insurance deduction. If the person is self-employed, they don't get health insurance benefits from the employer because they don't even have an employer. They're all self-employed. So they may have to go and buy their own health insurance because health insurance is mandatory. So what IRS is saying, you can deduct 100% of payments made for yourself or for your dependents or for your spouse. Again, this is a one line item that we'll see in the adjustment line, self-employment health insurance deduction. The last topic here is going to be on the retirement plan. This is something we'll do tomorrow because that's, again, we need to, there are a lot of different kind of retirement plans. Retirement plans are like 401k plans and all. So how much money can be put in there? How much tax break can one get? And all those things that we'll do tomorrow. Okay, the next one is alimony and all, which is fine. Okay, any questions?